Hey everybody, welcome back to Generating Income in Your Portfolio. My name is Mike Fairbourn. Hope you're having a good day in the markets. It's been a very interesting week. Folks, again, we want to pick up on the theme that we've been discussing in terms of valuations. Valuation specifically for dividend paying stocks. We ran into a little bit of a hitch last week, as you remember. We got past that. I've got some additional stocks to show you today, dividend paying stocks specifically that are tied into the PEGY ratio, and some ways to look at that and kind of interpret that with a number of stocks to look at today. So I really want to tie in the stock performance. How does the stock look relative to what's going on behind the scenes? Lifting up the old trunk and just saying, hey, the trunk or the hood. I guess it'd be the hood. The trunk might not tell us as much as looking up the hood, but in terms of specifically, what are we seeing with the valuations, earning expectations relative to dividend payments? So looking forward to it. It's going to be really interesting, and I look forward to actually talking about the PEGY ratio, specifically the PEGY ratio in this class going forward as well regularly. But with that, I would like to welcome you all here today. It's good to have you. I'm joined in the chat by a good friend, a colleague of mine, James Boyd. You'll see me in the chat as JB. I think many of you do know JB, and he is actively already in here. Excellent. Yeah, you can follow us both on X. My handle is just Mike Fairbourn CS. His is James Boyd CS. Well, with all that, let's get started with some disclosures so we can get on into this. Plenty of cool things to take a look at. Options carry a high level of risk and are not suitable for all investors. The information here is for general information purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Paper money software applications for educational purposes only. Now, investing does involve risk, including loss of principal. Past performance of any security strategy does not guarantee future results or success. And some final points here. Of course, we do want to make sure we mention that there are risks associated with investing in dividend-paying stocks, including, but not limited to the risk that stocks may reduce or stop paying dividends. All right. Well, that's going to be our focus today. In terms of those dividends specifically, we'll go ahead and go full screen here for just a second and take a look at a few details. I want to just quickly review what we've seen over here with the markets. In fact, I'll pull this up right now and we can take a look and just see how the markets are performing broadly speaking. I wanted to pull up the S&P 500 index, kind of show you that very big spike that we'd seen, many are calling it like the Trump bump or whatever the case might be. Yes, but you see that massive gap right there, right? Around the earnings announcement, elections. I've been looking at earnings for the past hour or so, expectations for earnings after the bell, but with the election results. Now, what we want to talk about, just broadly speaking, because I'm seeing a few names that I hadn't seen before. So in our chat, I know many of you may have already seen this, but if I'm just going to scoot on down to seasonality, and let's now reference this with kind of a week under our belt, roughly speaking. Are we matching a bit of a seasonal time frame that we have historically seen? Well, here we are. We did break out above some highs over here in November, looking at the 5-year average, right? Oh, there we go, the 5-year average. And you can see that we did break out. Well, what's interesting is we did break out here above our recent range as well. And we do know for sure that the trends are up on both ends. Now, this doesn't have to happen, but seasonally on average, that is, it's a key point on average. November tends to be a fairly strong month, and it does tend to run to the end of the year. The Santa Claus rally, for example, you may have heard those. That's just a term that's thrown out there in the markets. I'm going to go and throw this into a 10-year to kind of show you the same illustration. To get the illustration, though, again, I'm going to go ahead so we can see it better, because these were obviously at lower levels. The S&P was for the 10 years. You can see we're substantially higher. So what you do want to do is just go into your gear icon. Price axis shows a percentage, and boom. Now you see it as a percentage basis, and there you can see 10-year, you still get the rally in terms of a bump. And a lot of times, notice there is a continuation here in terms of what happens seasonally on average, and that is revert all the way back over here now, back to January, You see this rally up in February. Now, if you take out the pandemic, which really messed up February and March, you generally tend to get, and you got this the last couple of years, kind of a rally up through to March, or at least, within the last year or so. a rally up into March. And that has been on average, but the pandemic has messed up those numbers just because it was such a massive move to the downside. But generally you will, on average, get a run up to March if you exclude that pandemic year, which is what was that? Once in every 100 years? I heard 150 years or so. One more examination. There's your 20-year. You can still see it, and we may be on a seasonal lift. And we are seeing, thinking in terms of seasonality and what you do get a lot of times in seasonality towards the end of the year. What can drive it are some of the retail type stocks out there, or just retailers in general. Here's one. I'm just going to throw this out here. Costco. Let me get those percentages off real quick. But Costco is one that, I mean, if you think about people buying product for the end of the year, seasonally, the seasonal end of the year as well, there is a jump in Costco. Ooh, getting close to that 1,000. Some traders will say too, and I've read this, that if you get above 900, they think, oh, you kind of just get sucked up to the next level, the next to 1,000. Will this always happen? Of course not, but they've seen that there are historical kind of perspectives of that. I've just read about that. I don't have anything to cite specifically, but you've got that. You'd also see something like that around 90 to 100. If you start to get above that 90, a lot of times prices get sucked up to here because people start to believe, oh, it's going to go to 100. I want to buy it, and then I could sell it when it's 100 or it's 1,000. There's a lot of different potential kind of ways to look at it through kind of a psychology prism, investor psychology, but that's one of them. And so we'll see what does happen here. But another one, what's another one, you guys? What do you look at? What do you look at? This is a little bit aside from our discussion today, but I wanted to throw it out there because it is fascinating. Not BMY, my gosh, BBY. BMY was up though. Best Buy. Can Best Buy bounce and start to trend up higher here? Did have a good earnings announcement. I'm just thinking of retailers. But there you go. I mean, okay, somebody's going to say Walmart perhaps, right? Walmart might come up. Walmart's just kind of, wow, look at that trend. It's just really kind of steady, isn't it? Doesn't mean it can't change, but that has been on. If I were to come over here and just grab a slope right off this trend line, a drawing tool I use right here at the bottom, look at this. Look how consistent that slope is through there. Wow. You're getting a lot of the midpoint range. Not to say that will continue, but there's that 90 level. We just looked at 900 to 1,000 on Costco. Will it continue to climb? That is the question mark, but fun things to look at. Nice move in BMY, exactly. Bristol Myers, which is not a retailer, but I happened to hit the keys wrong. Okay. All right. Well, let's do this. Let's jump back in to last week's discussion because I really wanted to get into more details in terms of the PEGY ratio. Very interesting way to observe, to try to value dividend paying stocks. So just big picture again, I don't want to go into too much detail. I discussed this last week. I believe we will. I can maybe throw the playlist into the chat here and you can take a look at last week's discussion, which might be really helpful if you want to take a look at that to understand a little bit better. But let me give a really super brief overview. We talked about the PE ratio, how that can be an interesting valuation metric. Of course, it's different amongst industries for sure. And it's the most popular valuation metric that I read about, that I heard it was the most popular valuation metric out there. The PE ratio for valuation can be helpful. But what do companies do with those earnings? Some of them will plug those earnings back in to the company. Some of them will, hold them in terms of, just kind of retained earnings. A lot of things can change the PE ratio, but when you start to get into it a little bit more and you compare it with growth, and specifically, I'm going to put over here expected growth. That's expected growth. So it's anticipated growth going forward. Well, this is the PEG ratio. This equals the PEG ratio. And you can get an interesting valuation metric on the PEG ratio right off of Schwab.com, which we'll pull up here in a screen here in just a moment, stock screen. But anything less than 1 would tell us that the growth rate down here is actually higher. Interesting. Think about it. The growth rate, the company's growing, expected to grow, I've got to mention that, expected to grow higher relative to what the PE ratio is at, and this is lower. So to get a -1 PEG ratio, can you see, folks, visually see the valuation here that's occurring? You're able to buy price to earnings, the price of the stock relative to the current earnings, the trailing 12 months of earnings is lower relative to the expected growth of the company over a period of time. That is, in fact, the PEG ratio. And that's why a lot of people will use this to say, well, is it less than 1? Could be interesting. I'm going to add to it real quick. I want to keep the PEG ratio up here right now. And I'm going to put a line through here, and we're going to add something to this. We're going to have the PE ratio. This is specific for dividend paying stocks because companies that pay out big dividends, sometimes they grow slower, but they do give out a dividend. Some of them are very consistent, right, with those dividends. So why didn't we factor the dividend yield in too? It's a component that you're not getting up here with growth stocks. Many growth stocks don't pay that. Okay, so we've kind of added to this. We still have our expected growth down here. Parentheses is expected growth, but again, what we're doing is we're adding to this. Plus, change the color here to emphasize it. The yield, the annual dividend yield. So it's not just the PEG. This equals the PEGY. Now, I'll tell you what I would do. If I could draw a couple of gals, PEG and PEGY, I'd put them up here, but you wouldn't be able to distinguish what I was doing because I can't do that with this big fat marker. What I can do is I can write PEGY for you. You got PEG, you got PEGY, a couple of different perspectives, but this one is clearly, folks, around dividends. This is all about dividend yield. I mean, how do we account for that in such a fashion? So, in other words, we might not have such a high growth rate because many of these companies are consistent in paying that dividend because they want to see over long periods of time. And we've seen this with a lot of dividend aristocrats, although not all of them, but the idea is just slow and steady growth over the years. I'm kind of pointing to, like, let's say, for example, a stock trend. That's what they would like to see, just slow as she goes, steady as she goes, and just they make sure that each and every year they've got enough money to put into that dividend. So we give them credit for that with the PEGY ratio. Okay. So last week when we tried to pull this, we ran into an issue, not this week. All right, let me see if there are any questions I can answer here. By the way, as we're pulling this up, a quick note, as I just noticed, there is a survey link in the chat. If you find this kind of discussion helpful or useful, really appreciate just filling that out. There's only 2 questions. Any topic requests, I do handle those, and I get those directly from my manager because he likes to read every one of those as well. So I appreciate if you're able to do that. And folks, while you're at it too, if you like today's presentation, smash that like button and definitely subscribe in the bottom right-hand corner of the screen. I'd love to have you on with us. We are over 125,000 subscribers. And let's continue on. Let me just see what we got. No, I think we're okay. James has got us all caught up here. I think we're looking good. Cool. All right. So that's that. Now, the key point is, because we want to tie this specifically into stock, so we've got to jump into this, and we're going to hit this right on. So now, quickly going back into this, if I were to look at a company like, for example, let's just say Merck. Now, Merck has come down a little bit here. But there are expectations for like a company like this, if there were expectations of this company. And you can see over here on a 2-year chart, we're kind of back into this lower range. I realize we're dipping today. It's kind of a little bit of a dip. But let's just say, for example, there was an expectation as you are approaching this big round number, 100, that a lot of companies have bounced off of previously. Historically, it can be a big picture support level. It might not be, but obviously you can watch it and see if that's what happens. Here is Merck. It's been downtrending, but longer term, this was like a high that we had earlier in the year, and we had been kind of making similar lows and higher highs. Now, this is a company that does pay dividends, and you can see that they have been increasing the dividend. In fact, they've been increasing the dividend for a little bit. It doesn't mean it's going to continue. It just means that they are increasing the dividend. So as we talk about this, what happens to that dividend yield as prices are dropping? The yield, as long as the price goes down and that the dividends payments keep increasing or at least staying the same, that yield, folks, is going to jump up. We're at 3% now on yield. This is going to be getting yield on Merck. This is going to be getting into the higher ranges. What we've talked about previously, bring in prior discussions. Let's do it right now because this is really important. I want to make sure we don't forget about this, right? This historical yield that we said there is a tendency for some companies to bounce off of these levels. Let's just get this really thick so we could see this. And we can see, like, for example, here is Merck. Okay, that's a 2-year Merck. What happened the last time Merck got close to 3, right over here? Here's 3%. Some companies get very interesting. Income-minded investors will focus on 3%. Sometimes it's 2.5, but 3 is often an area they'll look at because that's what they get interested around 3%. And that can be due to a lot of different things, namely exceeding inflation and long-term historical inflation rates are keeping up with inflation. Look over here with me. When we got down to this level, we got very, very close to 3. I'm going to back it out to show you even a little bit more. Let's just jump back a little bit here. And we're going to go into, let's just say, well, let's double it. Let's go to 4 years. There we go. Okay, so 3.35. I wanted to pull in a little bit more data, but if you come over here, right into about the 3.5, which we're on the verge of getting to right now, these were kind of long-term bottoms. And sometimes off those bottoms, prices can spike. Or like I said, here's the 3% level. And it's a little bit different because we are sort of in a longer term uptrend, although intermediate, we've come down. Look at this, 3. Okay, we can bounce through here. We don't know if we will, but keep eyes on it and see what happens. I want to talk about this because what if the valuation, what if the expectation of the growth in this company for the next few years out was high enough that it shot that PEG ratio below 1? Would that change your perspective, perhaps, in terms of this company? The way that you see valuations and maybe the potential of the trend? I mean, because here's the thing. We could also measure PEG over here too and see where that's at. It'd be very interesting to see what happens when it gets below 1 at long-term support and above 3% yield. As an example, we might find several out here. We don't know what's going to happen, obviously, but this is just an example case. But guys, if you want this, if you don't have this yet, let me make sure you have that historical dividend yield because you do really get to see some really interesting points. Like prices might top around 2%, might bottom around 3 on the yield. Income-minded investors might sell at that level, which you wouldn't normally see. So let me just make sure you have this. We'll throw this out into the chat, and I can make sure too that this is shared later for you. Okay, let's go ahead and do this right now, and I will just share it. Okay, I believe this is one from a while back, but doesn't matter. There you go. Okay, I think many of you do have it, but here it is. Okay, and by the way, anytime we are sharing scripts, remember the scripts aren't guaranteed for timeliness or accuracy. Now, having said all that, we got to jump over here because I want to get a number of these companies. I want to see where Merck's at on our list. In fact, if it is there, let's pull it up. Now, you guys know me. I probably wouldn't bring up this example if we're not going to find it in our list. So let's do this. Let's take a look and just see over here what we've got. Now, again, this is from last week's discussion. I went into research here, and then I went down into research, the screener, and I've added these columns in. And again, let me just quickly show you how I did this. I went into the basic because I want to look at the S&P 500. Maybe those companies have been around for a little bit longer. Maybe some records of historical growth and strength. Remember the Dividend Aristocrats that you guys can get full access to over here now, right over here in the watch list, or the public watch list folder right there, 25 plus year dividend yield increasers. There's the 50 year. Those are the dividend kings. Got the aristocrats here. All of the aristocrats are in the S&P 500. So I've added that into our basic. Boom. Next thing up, price to earnings. I wanted to see what the price to earnings were. You can put that under valuation. And then you've got company performance, By the way, the PEG ratio, undervaluation, company performance here and here. Notice this is the next year out growth rate. This is the 3 to 5 year growth rate, and there is your annual dividend yield. Folks, we have everything we need there. Not only do we have the PEG ratio, it gives it to us right at our fingertips. We have the, well, PEGY ratio. Just add a Y to the PEG. You get PEGY. She's sitting right over there in that. I mean, and we can do this. We can add this up together. I've got everything figured out on the Excel spreadsheet. So we're going to be able to see exactly what's in the S&P 500 and what those lowest PEGY ratios are. Now, quick note on this before we dive into these details. Remember what we said on the PEG ratio? This is a very, very important point. A lot of times traders will say, yeah, I mean, if it's under 1, less than 1, they consider that very, quite undervalued. But they might say undervalued resides between less than 1 up to 1.5. Now, the same kind of general benchmark is used for the PEGY ratio too, 1 to 1.5 or less than 1 to 1.5. But I really wanted to go all out today and just say what is undervalued there with dividends. Because if the market does pull back a little bit, sometimes there's that rotation into income dividend payers and healthcare. We just looked at Merck. See if it pops up here. Okay, so I've put all of these in, and I'm going to make an adjustment. Before I even go there, this is a very, very important point. What did I say, guys, gals, around the PEG ratio? The PEG ratio. We said it was the PE ratio, which we've got right there. And we said it was divided by, because we wanted to see it relative to, on a ratio basis, that expected or estimated, it says estimated over here, here and here, estimated growth. Growth. Well, which column does it use? How does Schwab compute the PEG ratio? Is it this year, this next coming year, or is it 3 to 5 years longer term? Now, a lot of times, if it's 3 to 5, this is kind of an interesting range in here because you're getting a little bit more. Sometimes these numbers don't tend to be overly optimistic. Sometimes the front year can be overly optimistic. It can be, but 3 to 5 would kind of look at the traditional kind of expected growth that companies are anticipated to reach. So having said that, which one does Schwab use, folks? They use this one right here. So if we were to take this number, and how does this work? Say, for example, if we were using this A.O. Smith, this is such an easy one to use, actually. Look at A.O. Smith. I just caught it. A.O. Smith, the P.E. ratio, just slipping in right there. I want to keep everything up here on the chart. 19.81. Okay. Well, what is the PEG ratio? 1.98. Overvalued, right? It's above the 1.5. So if we take the PE ratio and we divide it by 10, we're going to get this 1.98, which tells us exactly how Schwab calculates the PEG ratio. I have seen the PEG ratio on some sites calculated by using this. I do think this one makes more sense, but I like to understand and see what the comparables are from one year to the next and see if they're somewhat close. Notice this one, next year, Aflac kind of low, but broadly speaking, in big picture, it's got a better number, 9.4, which is maybe more historically where it's at. But next year, it's quite low. It's very interesting to be aware of. By the way, when I'm using these estimated EPS numbers, we're looking at the S&P 500. Folks, I'm not looking at somebody's list of penny stocks. All right, I'm not saying a ton there, but I just want to let you know that that's something behind the scenes that you can actually really kind of consider when you're looking at these estimates. And you can also see how they've been doing historically. Now, we've talked a lot about this. We're going to jump right into the charts. If I go right to the export to CVS and I click on OK, CSV, I'm sorry, click on OK, it's going to pull this up, and now I've got all our results. Remember last week we had a problem pulling that data. Didn't have that problem this week. So these are all of the companies as they come up here, okay? Now, a quick note, when we are making those comparisons, these numbers that you're seeing over here, for example, in the estimated growth, I put the 1 year over to the far right because we are going to be using this for the PEGY. Although we could include this one if we wanted to. If you wanted to see a PEGY ratio using this, create your own PEG ratio, you can do it. we can do it. If Schwab gives us the data, which they do, it's fantastic. We can create our own PEG ratios based on this, just using an Excel spreadsheet. This is not an Excel spreadsheet class, but you can do it very easily just by exporting it. So we can create not only a PEG, but a PEGY ratio based on a 1 year, not to mention a 3 to 5 year, and do comparisons on both. Today, to make things a little bit more simple, we've just done it, the PEGY, simply on exactly the way that Schwab does the calculations. And notice this one's kind of like way out of whack. But I'll explain what I've done first. So over here, a quick note, we've got the PE ratio. What are the calculations we need? We need the PE. And what do we do with the PE? I'm going to put it down here so you can see exactly how that goes into an equation as well. Because might as well just talk about it again. There's our PE ratio. There's our estimated growth right there. In parentheses, we'll put it there. That's our growth. And then what we're going to do is look at the dividend yield over here on an annualized basis, and we're going to put this one in right there. Okay. Now, just to give you a sense of that, I had to create a column here, which is basically this down here. This column right here, the E plus the Y, which is expected growth. You know what? It needs to be EG, doesn't it? EG, expected growth, just so we have it. Oh, let's see. EG is expected growth plus the Y, whatever it is. I've just named that column. Okay. And so all I'm simply doing is I'm taking this, we're losing the percentages, and we're adding these together. Okay. Look at the expectations here for Merck. Pipeline of drugs. What people might not see, what an analyst has got over a period of time. What is the pipeline of drugs here? They consider it to be quite strong. Right now, what are they expected to do this next year? About 20%. Okay. One of those years in there, they're expecting a significant spike. At least. This goes out 3 to 5 years. Look at the PEG ratios. These are all less than 1 through here, right? Now we have that value perspective. Let's look at some stocks. I showed you Merck, but there are others in here that we can just kind of pick and choose. But as a quick note, actually, let me just hit this real quick. There is the PEGY. What does that do? Well, let me just show you. There's the formula right there. Not there, but right there. So I'm simply just taking this plus this, and I've had to remove the percentages. Can you guys see that all right? In fact, let me do this. I think I can just, doesn't change anything up top, does it, with the formula? Forget it. All right, but that's you've got to take both of the columns here, E and F, which is your expected growth and your annual yield. You've got to add them together and multiply by 100 to get to remove actually the percentages. And then with that, in the ratio column itself, all we're doing is we're taking the PE ratio, like we said we would do, PE ratio, and divide that by the earnings growth plus yield. And there you have it. That's your PEGY ratio right there. And I should bold it, right? So we can actually see a little bit better. But there you go. There is the PEGY ratio right there. Okay. And all I've done next is I've just highlighted this column, gone through here, make sure I've got all the columns associated with it attached to it. And I made sure I ran this with a dividend yield of 1.5%. That's basically what screened this data right here. 1.5% or higher, and I let all the other numbers float, whatever they were. I was just looking at that dividend yield as a way to screen it. And now what I did is I went up top and I just went to the sort and filter, sort the column, and I put column I, which was right there. And all I simply did was just go smallest to largest. And now there you go. There you get undervalued. And there you have it. Look at this. So there's kind of your cutoff right there. Bank of Mellon, all the way up. These companies right through here have a PEGY ratio of less than 1. Now, the one I would caution you on, and you want to look into more detail, is this one. It's just way high. Allstate, 172%. I don't know what's going on there. That's substantially higher than the earnings per share growth out next year. And you can, there are analyst reports you can read about these companies and see what the expectations are. But there you go. So this one is a little bit high as well. But this one with Merck is high as well too. It does have a good PEGY ratio, and when you take that yield in, There you go. PEG ratio, and then the PEGY ratio is good as well. Last but not least, I took all these, okay, because we got to get them over to Think or Swim. Copy, folks. Highlight every one of them. I mean, they're all interesting. Well, you don't need to do all of them. Here are the PEGY ratios that are, let's say, by the way, I'm sorry, I did screen the PEGY ratio at a 2 or less, the PEG ratio at 2 or less. So I made sure that we had companies in there that were already maybe a decent valuation, 2 or less. You'll notice 1.98. That's the cutoff, right? It brought us 47 stocks in this group, 47. We're not counting that top column there. And with all that, we could maybe potentially stop it. Like maybe let's just do this instead of all of the stocks. We're just going to go right over here. Well, we'll throw MetLife in. It just barely made it. Fine. We get about 23 companies out of the entire S&P 500 that are less than 1 in terms of the PEGY ratio. Now, copy that. We're going to pull this over here. And what I've done is I've pasted those in here for you. Just go into a watch list, create a watch list, name that watch list, hit import, paste, and you've got them all, and you can easily view them through here. Okay, so we looked at Merck over there. I'm going to keep a couple of these things on here. Merck is actually number 2 on the list. I scrolled through here. I want to look at a few of these as well. This stock has really been spiking up nicely right now. Okay. You can see now. You could always, reference the historical yield, etc. But the one point I wanted to bring up here is the fact that, look at the growth in terms of the stock. How is it doing? I don't know. I think from a perspective of an investor, a trader, they want to see the trend. They want to see something they can recognize, flag patterns or whatever the case might be. TRV, well, what does TRV have? TRV has, you got it all here because we did it to the spreadsheet, but there it is. Is that less than 1? It sure is. It's 0.735. So this is trading at a lower level than the PE ratio itself right now. Okay, when you think about it that way, we just know that the growth plus the yield is higher than the PE ratio, is what I should have said. Sorry, that's what I meant to say. So when you add the growth and the yield, expected growth and yield, it's showing value here relative to where it's trading at. Right? They're valuing it way low relative to what could happen. You see that? This could be considered undervalued. Undervalued right there, perhaps, right? And it's a low PE ratio relative to the growth and the yield. Let's take a look at it right now. So I'm going to pop it back over here. Again, let's look at more stocks as we go through this list. In fact, we're going to go through a few of these now, but there we go. Okay. So, yeah, kind of a range-bound move, perhaps. I should say a pullback to the prior highs, a bounce. Will this trend continue? What does the longer-term chart say? These could all be of interest. I'm going to go down. And by the way, what are some of the trends we're seeing in here? I'm seeing, okay, so Allstate is in here. I want to check those numbers, but so is Prudential and others. We could also put over here too, just to see if there are any additional themes that we might be able to pick up on, where we're seeing projected strength expectations in terms of the growth of the company with the dividend payments, expected growth and the yield in certain sub-industries. So sub-industry column could be totally helpful here too. In other words, where is this coming up at? Right there. We'll just put a sub-industry. I'll pull it over one. Do you see any general themes over here or areas that you might want to look into? Undervalued based on expected growth and the yield. Okay, so there you go. Insurance, 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 insurance. 3 insurances right at the tip, right in that range there. Okay, so think about that. What else are we getting as we go through here? Well, there was your pharmaceuticals, and healthcare is one of those companies. Pull it up real quick. We'll just jump out of this and go right into our grid. That if the markets were to have any kind of a pullback, what is healthcare showing? Staples as well, consumer staples. There are some staples we'll see in here too. I've seen them But by the way, there's another different insurance, but you got a ton of insurances in there. Look over here with me. Look at healthcare. Possibility of a longer term flag pattern. Well, if it starts to break that trend line, well, could it go higher? Maybe if the markets dip, it's a standard defensive sector, and some of these are defensive sectors, and you're seeing that come up within our list. What else do we have? Let's just go on down. Oil and gas. There's a lot of oil and gas in there too. Um, More insurance. Cable and satellite. There are some one-offs in there that just might present some of these companies being undervalued, but there's a list. So we've pulled that up. We've accomplished that. Let's go back to our regular charts, and we'll just take a look at these right now. So what about, some of the oil and gas? There is, so SLB, okay, we don't know if it's a double bottom or not. It could be a double bottom right through here. What about the long-term trend line? What are we seeing here? There's the trend coming down, down, down. Oh, we just broke the longer-term trend line too. Could this mean the change in trend? Possibly. You can see the dividend yield down there. Let's go full screen so we can kind of see this a little bit better. But taking a look at that, do we want to take a look at technicals? My gosh. I think sometimes we do, right? We want to see if maybe the value is starting to become recognized in the market. We've got some good data here to take a look at here to kind of reference this. There is SLB. Let's highlight it right there. Okay. PEGY, we said less than 1. Okay, what is the growth rate right there for the next 3 to 5 years? So about 14, real close to 14%. That's longer than the next year growth rate. And the PEG ratio just by itself, if I can line this up right, is about 1, right in that range. So very close. But when you add the yield in, below 1, it can make it, because it may appeal to income-minded investors is what we're really kind of getting at there. Okay. Let's see. How are we doing in the chat? Any questions on the chat as we go through this? I'm going to pull this up, but these are, I don't know, these could be very, very valuable data points to utilize with what? To utilize with this. What's going on with the chart? Boy, I'm not going to do a good job of this, but like SLB, taking out the longer term trend, will it continue? Well, what kind of data do we have behind the scenes, folks? Right there. Okay, oh, that's not pointing exactly to it, but you can see it. It's right there. 0.871 in terms of the PEGY ratio. Boy, I better have lined that up right, or I'll look like a real. There we go. There you go. So there you go. And by the way, this is cool too, because it does tell you, hey, where's the dividend yield at? Combine these together, okay, it's a pretty powerful factor. That factor is higher than the price to earnings. A lot of cool data in here to look at, but always look at it in terms of what you're seeing behind the screen, behind the scenes with the chart. I'm going to go back to this one more time and just kind of highlight this as we go into this and take a look at this. Will this break over here? A couple of different indicators that I chat about within the class that I teach on ThinkScript, and we've got it on Fridays. For example, well, I'll talk about it right now, but like money flow. How have the money flows been doing? Look at this. I mean, prices going down. Do we think that maybe the PEG ratio plus the Y, the PEGY ratio, expected earnings growth? What can we see over here with money flow? Remember what money flow picks up on? Money flow picks up on a long-term accumulation, and it generally takes, it's also known, it's been referred to as the smart money indicator, but it will tend to reflect bigger purchases out there on the market. And do you notice this down here? This volume kind of spiked up. This is saying that this is a form of accumulation. Now, you guys know I can't spell that all out. Won't even fit on my screen, but there is ACC for short. It's accumulating. It's not distributing. Money flow has been going up. The trend is up. Now, this is one of the indicators we chatted about in the ThinkScript that I built a little bit ago. But what it does is it combines components of momentum and money flow. And oftentimes what we look for in terms of strength is really holding, in this upper range up here. Because what's happening is even though momentum might have been waning off, you've got money pushing it up. And if it can sustain these higher levels, that's oftentimes construed as a positive, especially when prices are going down. So just some ideas. This is just an example. We could find other stocks in here too as we go through this. I mean, here's Dominion. It's in multi-utilities. Now, what do you see with Dominion? Quick note as we we kind of wrap this up a little bit here. Well, Dominion's been to the upside here. Higher highs, higher lows. Let's reference it. So nice to have this just in the backdrop. 0.87, very, very close to what we were looking at previously. Dominion Energy right there. Wasn't quite there on the PEG ratio. It was close. I mean, it's actually not too bad, but you add in that dividend yield in there, and there you have it. You are below 1, where there could be some value there. And behind the scenes, what have we had? Could there be a driver here? Are there expectations that these earnings numbers, right? The earnings over here, anticipated earnings, will continue to, if I just kind of look at the chart behind the scenes, the chart driving higher, combining, folks, what you're saying within the company, expected earnings, what they're paying out as the yield too, compared to the valuation using the PE ratio. What might we expect going further? Definitely tying in the chart. There's that chart again right there. Yeah. Okay. So some interesting things to look at. We didn't do class justice last time because, shoot, folks, things weren't even working when we were pulling them up. But at least we had some numbers in here. We talked about, how to formulate these spreadsheets and how to utilize this and how to create your own PEG ratio based upon just the next year out, which some companies do. Schwab uses the 3 to 5. But if you have the data, it can be done. But nonetheless, we talked about ways to do that. Hopefully you found that informative and useful. It can be very helpful, I think, when you're looking at companies. Can they sustain the trend? If that growth seems reasonable to us after we do the investigation of the company, and a consistency of the dividend yield, like we talked about previously, well, then there might be something there that could be of interest to us, for example, right? So that's all we're doing is we're just tying in all these different components in here, folks. So let me do this. I mentioned to you that I would pull this up because I do want to show you the playlist. And there we go. Presenter, chatter right there up top. Excellent. All right. That's just changed recently, I think. Okay, it was up there for a while. All right, let's just go over here. Just go boop, generating income, because I want to make sure you guys can see last week's class. Here is that playlist. I'm going to share that with you just so you have this. And there it is. It's in the chat right there. So it was last week's discussion, straightforward approach to dividend valuation, the PEGY ratio. That's kind of more broadly speaking. Today, we really tried to tie it into some of the charts to make it more useful. And hopefully that made sense. We made sure that spreadsheet was working as well. But getting both aspects of it is really what a lot of times it's about, right? Technicals, you guys are oftentimes very great at those, but really just, building on those fundamentals, which we talk about in this class. So on that note, again, be sure to subscribe, but there is that survey link if you're able to do that. Any topic requests or anything you found, informative, useful, whatever the case might be, we'll take a look at that and be sure to hit that like button. Folks, on that, see you next time, everybody. Have a great day.